Good afternoon and welcome to the Reed and Christine Halliday Executive Lecture Series. It's a great pleasure to introduce our speaker, Dr. James Croft, today. I think you'll find this a very exciting and timely discussion when you hear about his background. Dr. Croft is the founder of Mortgage Asset Research Institute, an organization which addresses issues of mortgage and financial institution quality. The acronym MARI, pronounced Mary, he established in 1990. Dr. Croft served as Mary's executive director for 14 years before it was sold to an Atlanta-based data services company. Since then, he has been retired, not exactly. He serves as a consultant for many companies and serves on a variety of boards, including the Woodbury School of Business National Advisory Council. We're very pleased to have Dr. Croft working with us and giving us his support and advice as we move the School of Business forward. Prior to founding Mary, Dr. Croft was the Executive Vice President of Risk Management at the Federal Home Loan Mortgage Corporation. You may know this organization better by its friendly name of Freddie Mac. In that position, he was responsible for development and oversight of Freddie Mac's mortgage underwriting and servicing standards, and so hopefully we'll get some insights into the checkered history of Freddie Mac and its current situation. Dr. Croft served earlier in the 1980s as the Director of Examinations and Supervision at the Federal Home Loan Bank Board. He oversaw a staff of nearly 1,000 financial institution examiners, and during his tenure there, his staff supervised the merger or closing of approximately 700 savings and loans. Dr. Croft has a PhD and was Professor of Statistics and Operations Research in the College of Business at the University of Utah. He also has written a number of articles and books. He lives currently in Great Falls, Virginia with his wife, Betty Jo. They have 4 children and 15 grandchildren. It's a great pleasure to have Dr. Croft with us today, and please join me by welcoming him.
Dean Wilson, thank you very much. It's a pleasure to be here. That paper from which he was reading was totally accurate, except it probably was a little more flattering than it ought to be, which is understandable because I wrote it myself. It truly is a pleasure to be here to participate in the Halliday Lecture. Reed Halliday and his wife are wonderful, wonderful people, and they are extremely dedicated to UVU. The Dean mentioned that I've spent a lot of time back in Washington, about almost 30 years now. And when you're in Washington, you get a little different perspective on some of the things that are going on in the country than you may get elsewhere. How many of you are familiar with the fact that we're in the middle of a recession right now? You've noticed, okay. Well, what imploded first in the middle of the recession? Was it retail? Was it automobiles? Or was it the mortgage industry? The mortgage industry, of course. Well, I've spent a lot of time in the mortgage industry. As Dean Wilson mentioned, I was the chief national examiner for all savings and loans in the United States for a few years back in the 80s. And at that time, they were the originators, the primary originators of most of the mortgage loans in the country. Then I spent a few years at Freddie Mac as their chief risk officer back when they made good loans. And then founded the Mortgage Asset Research Institute and spent 14 or 15 years running that. So I've kind of been in the middle of mortgages for a long time. And what I would like to present today is perhaps a couple of topics depending on our time frame. First of all, the mortgage mess. Who done it? What went wrong there? And then maybe if we have time, I'll talk a little bit about lessons I've learned from 3 decades back in Washington, D.C. So let's talk about the mortgage industry, first of all. I suppose that most of you have not had a lot of mortgages. So what I would like to do is I would like to demonstrate the mortgage process, how it works, how it evolved. and then just briefly touch on what I would call the dirty dozen causes of the mortgage meltdown. Now, in order to do this, I'm going to have some helpers up here. Okay, I need 5 students to come up here and sit in these seats. Can I have 5? Would you help me out here? Okay, great. Somebody else? Would you help? Okay, come on, I need some females because the mortgage industry has a lot of ladies in it, very talented people. Do we have anybody? You're not a lady, but you can come up anyhow, okay? And come on, let's have some gender dispersion here.
Up here, Dr. Croft. Come on down.
Okay? Okay, come down, please. Let me see, what have we got? 4? I need number 5. Where is number 5 going to be? Oh, one more person. You aren't going to have to say a thing. Okay, great. That was the deal closer right there. You don't have to say anything. Okay, now, I would like you 3 to pull your chairs back about a couple of feet right against the screen here because you're not in play right now. And would you like to, why don't you sit here? I think that would be best. All right, can you come over here? Yes. Very good, thank you. Now, each of the people in the row here, no, you have to be up first. You're the first one because you are the banker, the mortgage originator that starts the whole process here. And I'm going to tell you how this used to work back when I took out my first mortgage loan. Now, people would come to the banker and they would give the banker deposits. Okay, there you've got a lot of money. Are you happy? Okay, good. Make sure that everybody can see you've got deposits there. Okay, now I, Jim Croft, would like to come to my banker and take out a loan. Now, when I go to the loan, it looks as though I'm having a little bit of difficulty up here with my slides. I think we can probably get somebody back there to click off for me on my AVG notification. You do have Wi-Fi here, don't you? Okay. Well, anyhow, I want to take out a loan. Okay, and so I'm going to go down to my friendly banker and I'm going to say, will you make me a loan? Because you have money. And I need the loan to buy a house. So what we're going to do here is the banker is going to make me fill out a mortgage application and then underwrite that loan, which means take a look at it carefully to make sure that I'm a good credit risk. And the banker knows very well that there are 3 C's in underwriting. You do know that, right? Oh, absolutely. Oh, good. And the first is credit. So she's going to go to the credit reporting company and look up my credit report to see if I have a good record of repaying any outstanding debts that I've had in the past. So that's the first C. What's my credit looking like? The second C is capacity. And she's going to get to know all the information from my mortgage application about how much money I make, what investments I have, what debts I have, and she's going to look that over and she's going to say, does he make enough money to pay off all of his debts plus the mortgage loan that he wants me to make to him? Okay? So that's capacity. That's the second C. And if I have to service debt with more than about 35% of my basic monthly income, then I'm looking risky. If I'm 35% or below, she's going to be feeling real comfortable, and I assure you I am below 35%, okay? You feeling comfortable now?
What?
Are you feeling comfortable about my, it's a tough underwriter here, okay? All right, the third C that she's going to look at is collateral. Collateral, in other words, the house. If something happens that I lose my job, if I can't make those mortgage payments and so forth, she's going to have to foreclose on the house and she's going to have to sell the house. So is the house worth at least as much as she's lending or more? In fact, if the house is worth $100,000 and I'm trying to buy or borrow $80,000 because I put down $20,000 as a down payment, that means the house is worth 20% more than the loan she's giving me, and she'll feel real comfortable. So she'll send an appraiser that works for her full-time to go out and take a look at that house and compare it to all of the other houses in the neighborhood and say, yep, that house is worth $100,000 and this guy only wants to borrow 80, so you've got an 80% loan-to-value ratio, which is rather good. So what she's going to do is she's going to make me a loan, and I'm going to sign all these papers, and I'm going to take that loan from her, and I will promise to pay monthly payments to her over the next 25 or 30 years, and she'll earn interest on that. And she'll take my loan and she puts it in her portfolio. Okay? That's the way it used to work. And what would happen each month, I would make my mortgage payment, and she would credit some of that mortgage payment to reducing how much I owe, the principal on the loan, and she would take the interest as income. And that was a great loan. It was in her portfolio, and it stood there, stayed there for a long time, and things were just really great. And every night when she went to bed, she'd say her prayers and say, please bless Jim Croft so that he can continue to make his mortgage payments on a monthly basis for the next 30 years. And hopefully it would work out, because she didn't want to have to foreclose on me and take my house. Well, now we're back here to working. Are we working? Well, maybe we're not working. Okay, we'll fake it. All right. Now, with this process, there is a problem. Because now, what is your first name?
Allison.
Allison has a problem. Allison, the banker, has a problem, and that is she's got this many dollar signs in deposits that she has to loan out, and she made me a loan with the same number of dollar signs. And what happens if Dean Wilson comes along and he wants to get a loan from Banker Allison? What happens? How does she do that? She's got two choices. She can go out and get more deposits, or what happened in the earlier 1970s and 80s is the government recognized that what we really needed to do is give Allison and bankers and savings loans like her the opportunity to get more money. And they set up a system. Given that I fouled up my presentation, by the way, I forgot one little issue here, and that is, Allison, if I happen to go, if I don't repay my loan, you're going to take a hit. You're going to take a serious hit, because your boss is going to be mad, the stockholders are going to be mad, the bank examiner is going to be mad, and this is going to hurt. So you really want to make sure that I am a good credit risk. Because if that loan goes bad, that would really hurt, okay? Well, what happened after a while here? Oh, look, we're back online. We checked the three C's, and we have now got ourselves to the point where the old way had a problem, and that is, once the bank loaned out most of its deposit that it had collected, it couldn't make any more loans, unless it went out and engaged in the expensive process of gaining more deposits, or it did something else. It used the facilities of Freddie Mac, Fannie Mae, and Wall Street. Okay, we now need the three of you to come up to the table. I'm sorry you have to stay back for a minute. And what we're going to do, I'm going to show you who these people are. Okay, we've got Allison the banker, and your name is?
Spencer.
Spencer. We have Spencer. Spencer represents Freddie Mac and Fannie Mae. Freddie Mac and Fannie Mae were government agencies that were set up to purchase loans from people like Allison. They would purchase loans, and then they would sell their interest in those loans to people like Glenn. Glenn is very happy because he is a Wall Street banker, and he makes millions. Big bonuses. You know, all those people who have been making bonuses you've been hearing about? That's Glenn. Okay? And then we have Josh. Okay, Josh is over here, and Josh is an investor. He may work for an insurance company, a retirement fund. He may be a Wall Street guy, just like Glenn, or he may be a foreign government. But he buys the things that Wall Street sells. So what we have in this case is the mortgage loan that was in Allison the banker's portfolio. She sells to Freddie Mac. Would you hand that over to Freddie Mac there? And now Freddie Mac does something with that. Freddie Mac gets several loans like that, several loans from several different bankers, and puts them all together. Okay? And puts them all in a package of loans. You put those all together, and issues something called a mortgage-backed security. Okay, why don't you staple those together? Make it look real nice, yeah. And sell it to Glenn. Hey, that's got my loan in it. It's really a good loan, Glenn. Okay, Glenn.
It's got all those other ones I didn't want. They got one good one and three that are not so good.
Oh, Dean Wilson, his loan's in there. Yeah.
I really want to give it to this guy.
Okay.
Now I know who's in here.
Okay, now you're a Wall Street banker.
Okay.
And one of the things that the Wall Street people do really well is they have these channels of distribution where they can sell financial instruments. And so Glenn is going to sell that financial instrument to Josh. Okay? And isn't that just great? Josh, are you happy to have that?
It's lovely.
Good. We don't know whether you're an investment company, a foreign bank, or an insurance company, but you are a really wise investor to have bought that. Now, what happens when my mortgage payment comes in or the other mortgage payments come in? First of all, the payment comes to Allison. But Allison doesn't own it anymore, but she takes the payment and she services the loan, so she gets to keep a little of the money. Would you cut a little corner off there?
Just a little?
Just a little corner. Oh, you're getting a pretty big chunk there. Go right ahead, go right ahead. Okay, this is Allison's payment. Now, pass it on to Freddie Mac. Now, Freddie Mac has also been in the chain, so Freddie, you get to take another corner.
Mine's a little bigger than hers.
And then the payment gets passed on to Glenn. And Glenn, of course, Wall Street.
You know what happens with Wall Street?
Yeah, that's a big payment. And then by the time it gets to Josh, Josh the investor has got himself a payment, and he's a happy camper. Now, all of this works out really great, right? It seems to be working very nicely. Fannie Mae and Freddie Mac combine these mortgages together. They sell their interest to Wall Street or to insurance companies, mutual funds, governments, and so forth. So that's what you've just seen. And every time I make my mortgage payment and other people make their mortgage payment, each person in the line gets a little nick out of that payment. Okay, make sure you keep your nicks there because they're very valuable, okay? Now, Wall Street can package the loans, sell them off, and all sorts of things. Now, What went wrong? Doesn't that seem like a good plan, good way to do things? Well, I'll tell you what went wrong. Back in the early 1980s, the Federal Reserve deregulated interest rates. And interest rates, instead of being very, very stable over a long period of time, began to gyrate. They would go high, they'd go low. In the early 80s, when I was back at the Federal Home Loan Bank Board in Washington, D.C., prime rate reached 20 to 22%. A lot different than it is now. And then interest rates would drop back, and they fluctuate. And you see the fluctuations, probably have seen them over the last several years yourself. Now, Allison, the banker, you have loan officers working for you, and you have appraisers working for you. And now that interest rates are fluctuating, when interest rates are real low, are a lot of people going to try to take out loans, or a few people?
A lot.
A lot of people. And you'll need lots of loan officers and lots of appraisers. But then interest rates shoot through the roof and nobody wants a loan anymore. What are you going to do with those people?
Get rid of them.
Get rid of them. See, I told you she was tough. Okay, the problem is with gyrating interest rates, Allison never has the right number of loan officers and appraisers on her staff. She has a serious problem. So she decides that she needs to outsource everything. And so she's going to lay off her loan officers, and your name is?
Cassidy.
Cassidy? Cassidy used to work for Allison. She got laid off, and now would you pull yourself up to the table here? She is now an independent loan officer, and she is a mortgage broker. Mortgage brokers enter the scene, and mortgage brokers are the people, they don't work on salary for the banks, they work on commissions. And the more loans they make, the more money they make. Now, Allison, or Cassidy, you are a very good mortgage broker. And I see that you have just gone out and originated a whole bunch of loans. Now, the nice thing about originating these loans is when you sell them or close them with Allison, okay, put them all together there, she's going to pay you a commission on each of those. Okay, so would you pass those over to her? And Allison, you just cut off the corner of a bunch of those. Hold out your hands because this is big money you're getting. Okay, Cassidy? Look at that. Look at what you just got. Now, but Allison, I'm afraid you still don't have enough money to own those loans, so what are you going to have to do?
Sell them to Freddie.
You're going to have to sell them to Freddie. Okay, so Freddie has got these loans. Show everybody your loans. They're really nice. Now, Freddie is going to, one more time, put them all together, staple them together, and sell them off to Wall Street. Wall Street has them now. You know, Wall Street got really smart after a while. And Wall Street, instead of just selling the loans per se to investors, like Scott over there, they started taking those loans and putting some of them in a small group, and some of them in another group, and some of them in another group. And Glenn, will you take those scissors there and put some of those loans, just cut some of them out, put them in something we'll call a tranche. Some of you may have heard that before. Here's tranche number one. Okay, you take a few of those and make tranche number one, and then make tranche number two. There's your staple gun. Tranche number three. Separate them into three tranches. And the reason Glenn is doing this is because he can get more money by selling those specialized tranches where he's grouped like kinds of mortgages together than if he just sold the whole pile of mortgages by themselves. So he's going to make more money, and his bonus is going to be a lot bigger. So way to go, Glenn. And did you put those all together?
Yeah, you bet.
Tranches? Okay, please sell them off to Scott. And Scott may even sell them on further. So we've got ourselves an interesting situation here. Now, what happens if my mortgage and Dean Wilson's mortgage and a bunch of other mortgages go sour? What if we can't pay them? Who's going to be the maddest in this group? Scott. He is going to take a big hit. Okay? I'm sorry, Scott, if it's a lot of those mortgages, he's going to take a really big hit. Okay. Now, what about Glenn? Well, Glenn is also an investor because he probably kept some of those tranches. So if those mortgages go bad, Glenn, you're going to take a big hit, but it's not quite as bad as taking it with this end, okay? But you're going to take a hit too, okay? Now, how about Freddie?
Baby hit.
You're going to get a hit. And Allison, you may get a little bit of a hit, but your hit is not nearly as big. And the mortgage broker, the person right at the front of the scheme here, you don't take much of a hit. And you know what? We changed the structure of the mortgage industry, where the originator of the loan originally 30 years ago, the person that originated my loan was on a salary, and if the loan went bad, she took a big hit, and now the person originating the loan is on a commission and gets rid of that loan, and if it goes bad, there's not much risk to her. In other words, Cassidy has no skin in the game. And Allison doesn't have nearly as much skin in the game as she used to. And Freddie has some, and Wall Street has some. The person that's really going to get hurt the most is Scott, the investor. Okay? Now, that's the way things were set up. So all of these mortgage payments started coming in from our mortgage people. Now, Cassidy, we're passing over you. I'm sorry. You just got paid. You got your commission, and you're out of the line. You're off making more loans. When it comes to mortgage payments, you aren't even involved. It goes straight to Allison. Now, Allison, pull off one of those little dollars, okay? Because you take part of the mortgage payment. And Freddie takes part of the mortgage payment too for its services. And Wall Street takes part of its mortgage payment. And on it goes to Scott, the investor. Oh, and here's another loan. Okay, let's pass this on to Allison. Take your part. Everybody's taking their cut. Whoa, big piece. Okay, and this keeps on going. Now, where is your money coming from, Allison?
Right here. You.
Right? Yeah, it's right there, and you get those mortgage payments. And how about it if Cassidy goes out and makes twice as many mortgages, she makes twice as many mortgage originations, she gets twice as much in commissions. And what happens on a monthly basis to your piece of the action?
It doubles.
It doubles too. And what happens to Freddie Mac? It doubles. And what happens to the Wall Street people that are just passing on to the investors? Their take doubles. And Scott over there is very happy. So what's important here? What's important? I'll give you a choice, volume or quality. Volume is the most important thing now, especially to Cassidy, because the more loans she makes, the more commission she makes. And it's also important to Allison, the banker, because she's got more loans that she's servicing, and she takes her piece of the, and it's more important to Freddie Mac, and it's more important to Wall Street, because especially these people that are closer to originating the loan, their hits aren't nearly as big as they used to be. So their focus became volume-oriented. Let's make as many loans as we possibly can because we make commissions, we make servicing fees, and everybody in the food chain is happy. Except if they go bad, the people on the very end are the ones that take the biggest hits. And the people closest to the origination process were the ones that take the smallest hits. That's sort of a conflict of interest. The people that are here making loans and designing loan programs said, we've got to design loan programs so that we can make the maximum number of loans. And we've already made loans to Jim Croft and Dean Wilson, the A credits. We're running out of A credits. Where are we going to go now? B credits and subprime loans, because we've got to have greater volume. And we have to have new kinds of mortgage instruments that make it easier for people to take out a loan. My favorite kind of mortgage instrument that was invented during this period of time is called the stated income loan, where you would go into the broker and Cassidy would say, have you got good credit? And, oh yeah, I've got great credit. My credit score is up around 800. And she would say, oh, good. All you've got to do is tell us what your income is. We'll write it down here. We'll pass it on in the application, and we'll do no verification. We won't ask you for your pay stubs. We won't ask you for your tax returns. We won't call your employer. We'll just take your word for it. I take my word for it, huh? Well, okay, I make a lot of money. Stated income. If I've got a good credit rating, and a bunch of lenders found this was generating a lot of loans for them. And Freddie Mac and Fannie Mae were saying, well, we'll buy those loans. And people were saying, Allison was saying, oh, we used to only take stated income loans from people with a credit score of 700 above, but our competitor down the street has lowered their stated income hurdle to a credit rating of 680. So let's go down to 675. And then the competitor went down to 670. Then Allison had to come back and go down to 660. And pretty soon, the stated income loan that was supposed to be made just to the very best A credits was being made to the very poor credits, because there was a ratcheting down of standards due to competition. The idea in the first place was not a bad idea. If you've got people who have patchy income, let's say, maybe somebody writes novels and they have a hit and then they have a miss and so forth, and they make a lot of money and then a little bit of money. On the average, they make pretty decent money, but having them produce pay stubs, they don't have pay stubs, and having them produce tax returns, their tax returns are lumpy and so forth. So, but as long as they've got a really good credit report and they've had high income, let's make those loans to them. But then as you start lowering the standards on the level of credit, that one C, that first C in the credit report, the more you lower that, the more you get into the subprime kinds of loans. We have to combine that with the fact that there were a lot of people that were speculating in real estate. Real estate was going to go up forever, right? Only a few years ago, people were saying, oh, you can't lose. All you have to buy is 2 or 3 houses, and you hold them. You don't even have to rent them out. Hold them for 6 to 9 months, and you can flip them, and you can get more money for them. And so more and more people were taking out loans. More and more people with lower and lower credit scores and lower credit ratings got loans. And when the real estate bubble burst, a lot of those people couldn't make their loan payments. And who got hit first? Scott, the investor, got hit first. And a lot of Wall Street firms got hit first. And you may have read about Wall Street firms that were on the brink and teetering and went into failure, and suddenly Wall Street firms like Merrill Lynch, that for those of us who are older, remember them being around for years and years and years. I mean, absolutely one of the best Wall Street firms in the country. They were on the verge of failure and they had to be sold off. And then it came further down the line, and Freddie Mac and Fannie Mae that had lowered their underwriting standards to be able to take in more and more loans to earn more and more of those fees, eventually got taken over by the government because they too failed. Now, fortunately, when I left Freddie Mac almost 20 years ago, I sold all my stock. Am I ever glad of that? And in fact, let me tell you why I left Freddie Mac. I was the chief credit officer in charge of the underwriting standards. And I was constantly battling with the people that wanted to bring in more loans. And I wanted to keep credit standards high. And I lost the battle, and I got fired from Freddie Mac for keeping credit standards too high. It's the best thing that ever happened to me. I was able to go out and form my own company, and that was much more fun and much more successful than staying with Freddie Mac. But I got fired for trying to keep the credit standards too high at Freddie Mac. And I'm not now saying I told you so, but I did. Okay. And so you see in this line of formerly sterling, rock-solid companies of insurance companies, investment funds, Wall Street firms, Freddie Mac and Fannie Mae, and even to a certain extent some of the banks, everybody is getting hurt because they forgot about the 3 C's and they started concentrating on volume rather than concentrating on quality. That's what really went wrong. So that is the number one thing in my mind about the problems in the mortgage industry. There were 12 of them. I've written a 14-page paper that deals with the 12 problems that I saw in the mortgage industry. If you want a copy of that paper, I can email it to anybody that leaves an email address up here afterwards. I'd be glad to do it. It's sort of been going around the rounds on the internet now, sort of like a bad joke. A lot of people keep circulating it around, so I get calls from time to time from people. But I believe the change in the structure of the mortgage origination process from back in the old days when Allison the banker made all the decisions, and now we have people originating loans that have no vested interest in them, and the risk gets passed way, way down the pipe. That change, I believe, was the number one cause of the mortgage debacle. Privatizing Freddie Mac and Fannie Mae, there are a lot of reasons why Freddie Mac and Fannie Mae got privatized. Some of them were good. But when they became private corporations instead of government agencies, they had to make a lot of money. They had to take a lot of those little clips out of each of those mortgages. And so they let their focus get away from quality and on to volume. The mortgage industry and Wall Street innovations, things like the stated income loan. Let me tell you about stated income loans. Let's see. If you go in, and Cassidy, the mortgage broker here, says, we think we can qualify for you for a stated income loan, but you need to be making $125,000 a year to qualify for this loan. You need to be making $125,000 a year to qualify for this loan, and you just have to tell me how much you're making, and I'm writing it down, and nobody's going to check it. Now, you need to make $125,000 in order to qualify for this loan. How much do you make? What are you going to say? You're going to say $125,000, right? Whether you do or not. Well, a client that I had was a big mortgage company, and they had a lot of these stated income loans, and they noticed that a lot of those loans were going bad at a high rate. Now, they said, what is the problem? So they went back, and fortunately, they had collected a little form from all of the applicants that said, we're going to go to the IRS, or you give us permission to go to the IRS and check your actual income, even though this is a stated income loan. Now, if any of you have ever been to a mortgage closing, you sign a stack of papers about this high, and everybody goes through, and so all those people had signed that. They had no idea what they were signing, right? I mean, those of you who've taken out a mortgage, you just sign all those papers. Okay, so they had these forms called Form 4506. And so this client of mine took these 4506 forms on their stated income loans, and they sent them to the IRS, and they got back all the incomes of these people as reported on their tax returns. Do you think they were accurate? 95% of them had exaggerated their income. And the shocking thing was that 60% of those people with stated income loans had exaggerated their income by half or more. So if they were making $50,000 a year, 60% of them said, oh, I make 75 or even more. That's why those loans, even before the study was done, was called the liar loans. Because everybody in the industry knew that on stated income loans, people were lying. But did they care? No, they wanted to be able to clip, each of them wanted to be able to clip their little nick out of those mortgage payments. Because volume was important. Quality wasn't important. And besides, if those mortgages go bad, real estate prices are going up so fast, we can sell the house, recoup our losses until, whoops, the real estate bubble burst. And Scott took a hit, and Glenn took a hit, and Freddie, I forgot your name, Freddie? Spencer Freddie took a hit, and even Allison took a hit. Cassidy, congratulations. You are still driving your Mercedes. Okay. So that's essentially what happened. I got a little deflected there. Why were some of these people buying these tranches and paying a lot of money for them? It's because credit rating agencies like, who are they? Do you know who they are? The Equifax, TransUnion, they do personal credit. The ones that rate bonds and tranches of financial instruments are Moody's, S&P, Standard & Poor's, Fitch. The credit rating agencies had no idea how these tranches were going to behave, but they went ahead and rated a lot of them much higher than they ever should have been rated. Some of the problem, I think, is hubris, where a lot of the people in the industry said, hey, we can price for this risk. There's no serious problem here. I would have to go into a lot of things about that. Congress, weak regulation of the mortgage industry. We have people in Washington right now, like Barney Franks. Barney Franks, one of my favorite members of Congress, who for years rolled over for Freddie Mac and Fannie Mae, and anything Freddie Mac and Fannie Mae wanted, he defended them against any kind of attacks or any efforts to regulate them. And now, who's at the front of the re-regulating the mortgage industry bandwagon? Barney Franks is right up there telling you, oh, I knew this was coming all along. He's a politician. What can you expect? Anyhow, experience and naivete in the mortgage industry. We went through an amazing boom period in the mortgage industry that lasted for 15 years. And some of the people that grew up in the mortgage industry had never seen a downturn. And since they had never seen a downturn, they didn't prepare for it. There were changes in accounting, too esoteric to get involved with here. The press and the media were playing up all of this real estate bubble. Some other problems, the housing bubble was contributed to. There were some flaky borrowers, like the people with the stated income loans. And there was a certain amount of fraud and misrepresentation. But back to our demonstration here, where I was so ably assisted by your fellow students, the change in the structure of the mortgage industry, where the people at the front end didn't have to bear the risks and take the hit, was, in my mind, the number one cause. Well, so here were the two biggest problems. Those originating the mortgage, I call them the gang of three, had no continuing interest in the mortgage. Who were the gang of three? Cassidy, the mortgage broker, and the now independent appraiser to go out and check the other C, the collateral, and then the real estate agent. The real estate agent didn't get paid unless the loan went through. real estate agents put a lot of pressure on financial institutions to get these loans through. Cassidy didn't get paid her commission unless the loan went through. A lot of pressure, she exerted a lot of pressure to get those loans through. And then the appraiser, an independent contractor now, no longer working on salary for Allison, depends for his or her referrals on the real estate agent and on the mortgage broker. So there's a lot of pressure to cooperate. A lot of back scratching that went on there. So the gang of three that right at the origination process essentially had no skin in the game when it went on. And then all the participants became motivated by volume. So where do we go from here? And we had the mortgage meltdown. That was the first phase of the recession that we're in. Where are we headed to from here? I'll give you 3 predictions. I think getting financial markets back to normal will take 3 to 5 years until they're really back to normal. Now, I don't know whether our economy is really turning around, but we've got a stimulus package that came out of Washington. The stimulus package, in my mind, is a little bit like starting a charcoal fire so you can barbecue. Have you ever started a charcoal fire? Put your briquettes in there, and then what do you spray on top? A lot of lighter fluid, and you put that match in there, woof, it goes to town. And if you're lucky, when the fire from the lighter fluid dies down, the briquettes have actually caught fire and they're producing warmth. Well, in our current situation, the stimulus that's been put in by the government into our economy is a little bit like the lighter fluid. And the big question that I think the jury's still out is when the stimulus dies down, will the economy be rolling on its own like those briquettes? So 3 to 5 years is my best guess. We will go through another boom period. Now, one of the nice things about being a geezer and old, and there are a couple of us here who can testify to that. Mickey over here has gray hair. I'd give anything for gray hair. But one of the nice things about being old is you've seen the ups and downs. And do you agree with me there will be another boom? Well, you hope, yes. That's when you want to cash in your retirement. But also, I predict there will be another bust. I've seen enough of them come and go. And the message to you is be wary of the booms. Those periods of time when it seemed like your investments can't go wrong, anything you do is right, and it's going to go on forever, I guarantee it will not go on forever. And if you are wise enough to realize that, you will be able to protect yourselves. Thank you very much. I'm ready for questions if we have a brief period of time. A couple of minutes for questions. Yes?
So with the stimulus money that they gave out for homes and cars this year, when that ends, does that kind of kill the market for next year? Because everyone who was thinking of buying a house is motivated to buy it now. What do you think is going to happen when they stop the stimulus money?
When they stop the stimulus, I think we will have dried up all the latent demand. And there we'll be back to just the normal demand, and that's the question of whether the regular briquettes will have caught fire. And I don't know what's going to happen. The cash for clunkers and the stimulus in housing, I think that's the lighter fluid. I wish I knew what was going to pick up. Are there any other questions? If not, Dean Wilson, it's all yours.
Croft, meeting with us today.
Thank you. And thank you for the help from my excellent assistants.